Welcome to the Spinoff Investing Simplified Spinoff Basics Investing course, brought to you by spinoffinvestingsimplified.com. All right, well, welcome guys. We're back with Richard Howe from stockspinoffinvesting.com, as well as myself from spinoffinvestingsimplified.com. Rich, how you doing? How you doing today?
Hey, doing well, Greg. How are you, man?
Good. So we were talking about just a couple of things that were changed for both of us. Let's share with our audience real quick. You can go first this time.
Yeah, so not a whole lot's changed. So I'm up in New Hampshire with my family, where we're quarantined at home near Boston, but we figured we'd just change the scenery. So we're up here in New Hampshire. There's a lot of hiking and things like that we can do. But yeah, just trying to hunker down here. I mean, luckily, my business involves just looking at stocks, and it can be done working remotely. So that helps. But I don't know what's going on with you.
Well, our viewers should notice that I'm growing a beard. It's my quarantine beard. Here in Twin Falls, we're doing the same thing, trying to hunker down. I'm a member of the Air Guard, and the Guard this year, or for the last couple of weeks, has been doing work from home for us. And I've been able to go out and spend a little bit of time during the day with my kids. And you can see behind me that I have a picture of Washington crossing the Delaware. Somebody, I'm sure, will notice that it's not historically correct, but it's still a great picture. So anyway, awesome. Well, before we get into our normal things on spin-off investing basics, we were going to talk about management today, but we got a great email from Jim. We didn't ask him for his last name, so I'm not gonna share his last name until we get approval from him. But Jim talked with us about one of the things that he uses to value investing in spin-offs, and it comes from some Joel Greenblatt lectures that he had access to, which you can find on the internet. I did some searching the other day and found a PDF with some of this stuff, but Jim actually gave us the lecture that has the valuation techniques on it. And we're gonna run over that real quick, just to kind of see that it's a little bit different than what both Rich and I shared last time, but it does give another perspective of it. So let me just share the screen here, and we can take a look at it. So let's see. So first and foremost, can you see that, Rich?
Yes.
All right, so here's the lecture, and the lecture talks about a company called Duff and Phelps. And the assignment for the class members was to take Duff and Phelps and then identify what they think the company would be worth at the end of 5 years, 3 to 5 years. And I created a little spreadsheet with that it looks like it hid for me. So give me just a minute, I'll get it up for us. I'm guessing you can probably see this. And go over here. Can you see it now?
It is loading. Hang on one sec. Yep, now it popped up.
Okay, so Duff and Phelps had a couple of things that it shows here, and there we go. So Duff and Phelps was a spinoff that Joel Greenblatt said was a perfect example of probably the best business you'll ever see. And some of the things that he looks at are EBITDA, and then he subtracts out maintenance CapEx. And in order to just make it a little bit easier for me to do this, I went ahead and just took the information off of his case study and put it into a spreadsheet. And I have this, you have the sales there at the top, and then the cost of goods sold. I like to personally look at selling general and admin as well, because I know that that's going to be in there. But from the example that he gave, it didn't have any of that information. Or it was minimal at most. And then you identify the earnings for the company, any interest that they had, taxes and depreciation and amortization. And I actually broke these out specifically because it makes it easier to do EBITDA, as he mentioned in his answer. And then finally, you have your capital expenditures. And one thing of note for anyone that's watching this, pay attention. These capital expenditures are not all your capital expenditures. This is your maintenance capital expenditures, what the company would have to use if they had a perfect example is the coronavirus. They had an experience where they have to just keep the doors open, but they don't necessarily want to grow because they're not sure about what will happen in the next 12 to 18 months. And so your capital expenditures are just maintenance capital expenditures for the company. And sometimes if a company does a lot of acquisitions, that can be a little bit harder to find. But in this particular case, these CapEx numbers are pretty similar, between 1 and 2 million each year. And then you also identify the net working capital of the company, you get the cash, the total current assets, total current liabilities, and net fixed assets. And that gives you kind of the net working capital. You add the net fixed assets to the net of the current assets and liabilities, and then you go ahead and add in cash for that. And that's just the amount of cash that you would need in order to maintain the business. Finally, when we look at the enterprise value, you basically take your cash and your debt and your equity. And I have other equity here just because I wanted to make this a spreadsheet that I could use later on. And there are shares outstanding and then the market capitalization for the company. So the actual enterprise value is your debt minus cash plus your market capitalization. And then when Joel Greenblatt does his valuation, he does a little discounted cash flow analysis. He adds the business growth rates. He assumes debt at the end of the 5 years. He also assumes shares outstanding at the end of 5 years. With Duff and Phelps, this is pretty important because the company has a lot of free cash flow, and then they had nowhere to put it. And historically, the management had not only said that they would put money into buying back shares, but that they would also buy back shares. And then I put in an expected price to earnings multiple just because that's what best fits the answer that he comes up with, which isn't, it's kind of weird. I looked through the numbers and I couldn't get the numbers to work. Maybe we can have a reader or a watcher tell us, hey, this is how you actually get the numbers, because I didn't get the same numbers that he had, trying to do as best as I could tell what he had. And so then I have a summary, and this is what comes up with the price to earnings indicated of 1.5 times your price to earnings ratio, and then a growth rate of 8%. After 5 years, your after-tax earnings is basically EBITDA minus your maintenance CapEx at a 40%, or subtracting out 40% for taxes. And the projected enterprise value is then basically your price to earnings times that number right there. Then you add in the debt to this should actually be your market capitalization, not enterprise value. And then the shares outstanding, and then the projected price of the equity at that time. And he was asking the question, so at $24, do you think this company is a two-bagger, or would it go up 100%? And he was saying, yeah, it goes up to about $50 a share, and you've already earned back all of your investment and then some. Some of the things that he identifies on this is there's a good price test. So the EBITDA minus your maintenance CapEx is 16.2 over that enterprise value that we talked about earlier. And that's an earnings yield of 11.1. He does that very similarly to the way that you and I talked about it last time, Rich. And then he also makes that a T-bill equivalent. So he takes out the tax. So 0.6 times this earnings yield, and that turns into 6.6. And he said, he makes the argument in that lecture, if I can get a company that I know is going to be growing at a 6% T-bill equivalent, then I might as well buy the company as opposed to the T-bill, just because I have expectations that it's going to grow over time. And then the good business test is very similar to what we were looking at, where you take that invested capital and you divide, that's the denominator in your EBITDA over minus maintenance CapEx. And in this particular case, he came up with 365%. I came up with 350, but I think that's kind of a Warren Buffett thing. I'd rather be roughly right than precisely wrong. And I think in this case, 350% versus 365% return on capital, I think that's a pretty negligible difference. But anyway, I personally, just my own experience, I like to look back at the historicals of your return on capital, which is why I put this next section in, and just a return on capital of what the company has done over time. So it does 350% the year that he's looking at it. The year before it was 253%. And then you can also do an operating earnings calculation, which is also something that he identifies, because he uses that to then go back and do his 5 years after tax. And so that comes down here, your future operating earnings, does it make sense? And that's one of the questions that Joel Greenblatt says that any analyst should be asking themselves. You have a growth rate of 19.1% and after-tax earnings of 15.6. And if the company continues to buy down shares, then it's a significant return on the equity for the company. So, Jim, this is to our watcher, Jim. We really appreciate you sending this to us. If you have additional info that you wanted to disclose with us, we would love it, but we really appreciate you sharing this with us. Rich, did you have anything you wanted to add to this, or things that came to mind?
No, I just wanted to walk through it. So just, I guess, starting at the top. So the PE indicated, is that, what exactly is that? Is that the current price to earnings multiple, or is that an earnings number, or what exactly is that?
So that is a guess that you make as the analyst. So you want to look at it and you say, okay, this is how much I think it should be sold at that time.
Oh, got it. So that's your fair value PE that you think makes sense.
Absolutely, yeah.
And that's probably, I mean, that looks like a pretty conservative number, 11.5. If it's indeed growing in such a high quality business, then that's probably conservative. But it's good to be conservative.
Yeah, since you pointed that out, Joel Greenblatt actually puts it at 13%, and let me see if it'll update. And at 13%, it comes up with a projected market value of $203 million from the calculations that I have. Joel Greenblatt put it at $180 million, and so I guess either or, you're in the ballpark with this. It doesn't really change much, but that's a very good point. Yeah. What other questions do you have on this, Rich?
And then the shares outstanding at the end of period, is that how many, is that shares outstanding, or is that shares that are likely to be retired, or what exactly is that?
Those are, so with Joel, the way he looked at it, he said, this is how much the shares will be at the end of the 5 years. And basically what he did is he went down and he took this cash flow right here at the bottom, and he subtracted that into the share count over the 5 years. And he assumed an 8% growth rate in the share price during that time. And basically, I think he started at 7.5 million, and he was expecting it to buy back a significant amount, almost half of their shares within 5 years. So that's a pretty aggressive return, but I looked at it and it's basically like, hey, we're going to take all of our cash and throw it back into this. And he makes that argument as he goes into it, that the reason why they can do that is because this is such a asset light business and a cash light business. They basically can grow without any type of additional property, plant, and equipment. So
makes sense. And then the good price test, so the EBIT minus maintenance CapEx divided by enterprise value. So that gets you an earnings yield a pre-tax earnings yield of 11.1%. And then basically you multiply that times 0.6 to get a kind of a fully taxed earnings yield, and then you compare that to whatever the Treasury bill is, and if it's attractive, then it's a good buy. Is that kind of?
Yeah, and that's what he's looking at. Is he's in true business fashion form. Oh, sorry, got something in my way. He is comparing it to the
risk-free rate, essentially.
The risk-free rate basically is what it is. And so he's just saying, hey, this is the risk-free rate.
Yeah.
And I'm just identifying it. So
yep.
And I just wanted to do that
okay.
because it was something that he had pointed out in that lesson.
Mm-hmm.
So.
Yep. No, that makes sense.
We spent a lot of time looking at that good business test the last time, which I think you and I both did a really good job at identifying what makes a good business test for us. I'm just curious, for you, Rich, do you have like a limit on how low or how high or how low you want the return on capital to be when you're looking at a company?
No, I don't, is I guess the short answer. I mean, I guess similar to a lot of investors that I've kind of grown to appreciate through lessons learned, that it's good to invest in good businesses. Because if you invest in a crappy business and then something goes wrong, you know, the downside, your downside really isn't protected. So it's nice to kind of have that built-in downside protection to have a really, you know, high quality business. So, you know, I don't have a hard and fast rule, but it's something that I definitely look at.
Yeah. Yeah. So an interesting thing about this is Joel Greenblatt also in that same lesson, he kind of gives the rest of the story for Duff and Phelps. Duff and Phelps had the spinoff and he went ahead and bought it for $24 a share. And the market started to realize that it was a good deal. So they started buying up shares. And then another company started to realize it, which often happens with spinoffs, and it got acquired. And it got acquired at about $100 a share. So that projected price actually was closer to that 20% growth rate at a price to earnings indicated ratio of 13% or 13 times. So it was just an interesting thing to watch with that. So
did he, and I need to review these notes, it's a good resource, but did he provide any commentary on kind of how to estimate maintenance CapEx, or was that something that maybe Duff and Phelps provided?
Oh, yeah, let's see. How did he go about that? Let me see if I can find it real quick. Can you see the lecture on this, or is it still in the Duff and Phelps?
Yes.
Okay. So let's see. I'll see if I can find it. I think he had, there we go. There was one more. Nope, you're right. I don't think he really dug into that too much. I think, so the thing that Jim pointed out when he emailed us this is he identified that the maintenance CapEx is usually a percentage of your sales. At least that's what if I remember right. That's how he approached it.
We talked to it. It's tough to you know, sometimes management lets you know what maintenance CapEx is and what growth CapEx is. Yep. Sometimes they're optimistic, right? They say, oh, we only have to spend $5 million of maintenance CapEx. You know, we spend 100 every year, but it's all growth CapEx. And, you know, sometimes that's not necessarily the case. So it's definitely an art figuring out what exactly maintenance CapEx is.
Yeah, and that is where the art is you kind of have to identify what does it cost to do that. I can't remember where I read it. I think it was another one of Joel Greenblatt's lectures, or maybe one of his books or something like that. But he talks, I seem to recall that he took some time to identify that your maintenance CapEx sometimes is associated with how much cash you have to keep on the balance sheet, because then that cash is used to buy in inventory and things like that. So anyway, awesome. Well, I feel like I've talked a lot. Did you want to talk about management first?
Sure, yeah. Yeah, so I think the other thing we wanted to cover was just how to evaluate management and specifically as it relates to spinoffs. And, I'm no expert by any means, but I would say I have definitely had a few lessons learned. What I typically am looking for. So generally when you're looking at the management team, unless it's at least it's been my experience, unless it's a, micro cap or a tiny company, you're going to read the resume of the management of the CEO and the CFO, and it's going to look really, really impressive, has done X, Y, Z, graduated from this fancy school, has done this, this, and this. And so it's kind of hard to suss out, what's a good manager, what's not. And I need to do an empirical work to actually figure out if this is the case or not, but it's been my observation that more oftentimes than not, if when you're evaluating a spinoff, if the new management team is coming from the spinoff, so the parent, so say whoever was ran the division before it gets spun off stays on as a CEO once it becomes a new publicly traded company, those companies tend to do well, and they tend to have fewer negative operating surprises. And you would think, oftentimes you see parent companies bring in, fancy highfalutin CEOs and CFOs from other companies to run their spinoff. But what I found is that oftentimes the CEO who actually knows the business is better suited to run the business than somebody that's completely brand new. And the reason why that's the case is with spinoffs, it's often a situation where there's a lot of low-hanging fruit. It's usually a division that's been ignored by the parent company. And then there might be some skeletons buried in the closet. So it helps to know where the skeletons are, where the spinoff sensitivities are, and where the low-hanging fruit is. To give you an example, Contour Brand. So that was a recent spinoff from VF Corp. And it's one that has performed well. It's actually absolutely gotten crushed in the past couple of weeks. I still think it looks interesting. But the management team is basically, the majority of them have come from VF Corp. And in fact, the CEO, Scott Baxter, for about 3 or 4 years, he ran the denim division, which is the spinoff now, Contour Brands. Contour Brands is mainly made up of 2 denim brands, the Wrangler and the Lee brands. And so he ran that business, ran it well, it grew while he was overseeing it, and then he got rotated to run some other divisions within VF. And then the other management, everybody in the management team is in VF, and that's good from my perspective for a couple of reasons. First, VF Corp is a stock that's done really well. They do a good job managing the business. So that's point number one. The new management team at Contour Brands has been trained well. But number 2, and most importantly, they know where the low-hanging fruit is, and they know where perhaps the skeletons are buried. To give you an example of low-hanging fruit, if you listen to Contour Brands, their Q3 call was really notable. They talked a lot about all the opportunities that they see in the market. Basically, Contour Brands, the Wrangler and the Lee brands were totally ignored as a part of VF Corp. And it makes sense why they were ignored. They were slower growing, not as exciting as North Face and Timberland and Vans and some of the other faster growing Vans brands for VF. And so, but there was obvious low-hanging fruit that just didn't get addressed. One point that Scott Baxter, the CEO, made was that, hey, we have one of the leading brands, denim brands in China, and Lee. It's a brand that resonates really well with the market, but we haven't launched Wrangler, our other big denim brand. And that seems to me like an absolutely no-brainer. You already have the infrastructure built out. You already have the relationships, the distribution partners, and you have the Wrangler brand, which is probably, a better brand than the Lee brand. And it just wasn't a priority for VF to roll that out in China. There were too many other things to focus on. Another one is Levi's is the other obviously big denim brand, or one of the other big denim brands. They sell, I think, I forget what the numbers are, but it's something like 50 t-shirts for every pair of jeans that they sell, or something kind of crazy like that. Basically, Wrangler and Lee sell like one t-shirt for every 50 jeans that they sell. Levi's has a lot more international sales, whereas Contour Brands is primarily primarily focused on the United States. So there's just a lot of low-hanging fruit that you would think would be an obvious area of investment that was ignored when this company was a part of the parent company. But it takes a CEO who knows that, who's been part of the parent company, to realize that there are these areas that are like no-brainers to invest in. And then in contrast to that, oftentimes you will see a management team brought in who has quote unquote spin-off experience. Like one example comes to mind, Residio, which is a spin-off from Honeywell. They sell comfort products as well as fire protection products. So think fire alarms, fire alarm systems, and also thermostats and things of that nature. And their CEO, not to pick on him, I'm sure he's a very, very capable guy, but like one of his claim to fame was that he used to work at Hewlett-Packard, and he helped arrange the Hewlett-Packard enterprise spinoff and subsequent merger with DXC, which had done really, really well. And so that was like one thing that was really emphasized as to his qualifications. And while that's all well and good, it's probably more important that you really know the business that you're managing inside and out and know where the opportunities are. And, consistent with the trend of when you bring in an outside management team, oftentimes you have operational hiccups. Residio, it's been a mess. They've had to take down guidance like 3 or 4 times. The stock's performed terribly, and the CFO, basically got fired. The CEO has resigned. They're bringing on a new CEO. So it's kind of the opposite of the Contour brand story. And then another example, there are a bunch of examples like this, like Arlo was another example of they brought in an outsider CEO, and immediately, they had inventory issues in the channel, and, they had to issue guidance that was super disappointing. And, I think an insider might have been better able to manage that transition. Another situation, and it's a stock that we talked about in terms of kind of lessons learned, but Quorum Health was a spinoff from Community Health Systems. And again, it was either the CFO or CEO, I forget who it was, but one of the selling points was, hey, this person's done a spinoff before. They've been involved with a spinoff before. And again, that's great. That doesn't hurt. But at the end of the day, probably more important to have somebody that knows the business inside and out.
Absolutely. I think that kind of goes back to what Warren Buffett looks at when he looks at companies. He says, after I buy it, I'm more focused on their operations than I am whether or not the stock price is doing what I want it to do. So yeah, that's a really good lesson to learn.
Yeah, exactly. Just focus on, you want to know the business inside and out. And obviously you want your management team to know it better than anybody.
Yeah, absolutely.
How about you? What about you? What are you, what are you looking for when you're kind of evaluating a management team?
Well, let me share this with you. So to me, aligned management is where the spinoff opportunity really is. Like you were talking about Contour Brands. I love let's just go back for a second to Joel Greenblatt's spinoff characteristics. He has some characteristics that he identifies in his book, You Can Be a Stock Market Genius, on page 69, where he says, these are the characteristics that I'm looking for. And this is characteristic number 2. He says, the insider participation is one of the key areas to look for when picking and choosing between spinoffs. And for me, the most important area. And that's his emphasis. He actually tells us that that's his most important area. And then when all of the required public documents about the spinoff have been filed, I usually look at this area first. And that's all in the same paragraph, just him identifying what it is. He also, it's kind of funny to reread his stuff sometimes. He says, a Form 10 is about as exciting as Gilligan Island's reruns, you know. So anyway, you can think about how exciting some of this can be. But
Right.
personally, I add a little bit more to it. I like to avoid certain things. I don't like to see activist investors in spinoffs usually, because usually it seems like they protect their investment before they protect the investment of the regular shareholders. That's not always the case, but it seems like it's a mixed bag from some of the research that I've done on spinoffs in general. It seems like a lot of there's statistically insignificant that activist investors actually make a difference for it. Management teams that have had a controlling interest in the company and don't have to answer to shareholders is another one that I worry about, just because I don't necessarily want a management team that runs in there, especially if it was in a situation that you were talking about where they come in, you know, on a white horse type of thing, and they don't really know how the business operates.
Right.
They're not going to listen to anybody, and the shareholders are going to be the ones that will suffer probably. For me, I always like to talk about the fish that gets away, I guess, you know. But Red Violet was one of those companies that I looked at back in March of, actually it was about February or March of 2018. And this was a spinoff from Cogent. And some of the things that happened with this, first and foremost, I looked at it and the management team in their Form 10 identified that their directors had 17.9% interest in the outstanding shares of the spinoff. I also learned from that filing that the management team would leave Cogent and go and run Red Violet. So all of their senior leadership was leaving to go and into this spinoff. The company wasn't earning any income, but the management team had a history at Cogent previously of diluting shares. So I personally looked at that and I was like, ooh, I might want to dabble in it a little bit. And so I bought I think I bought 100 shares at about actually I think I bought it at about $8.50 a share. And I was like, okay, then maybe I'll just see what happens with this, because Joel Greenblatt is telling me I need to focus on this. Well, the rest of the story is this. Right here, $7.48 is kind of where I got rid of it in April of 2019. And since then, it has gone well up beyond what I expected. And my lesson is that I need to pay more attention to those management team incentives. And really, if you look at it, even today, after the fall from the coronavirus scare, they're trading at about $17 a share. And so they have practically doubled in about 18 months. And the management team, the reason why I got out is because I had seen that they'd done so much dilution at Cogent prior, but I didn't pay attention to what they had done at Cogent prior to this, where they had run the stock price up so they could dilute the share so that they could continue to grow. That was my mistake. It's kind of hard sometimes to value a company that is not making money. And I can't guarantee that this is the only way to look at a spinoff, and you have to look at the whole picture. And so I don't know if it got away or not, but it's one of those things that I look back and I'm like, if only type of thing, you know. It's water under the bridge now, but
it's funny. I looked at this one too, and it looked really cheap. So with these ones, you know, with the unprofitable spinoffs, you know, the way that I look at them is on an enterprise to revenue multiple basis, and because obviously it takes into account. You can look at it versus comps, and it doesn't matter if they're profitable right now or not. You know, it's a way to value comparable companies that are unprofitable. And it looked really cheap, to your point. The issue was that you pointed out was there was all this negativity surrounding the management team and how they were self-serving and how they just paid themselves and the diluted shareholders. And that scared me off too. There was also a massive short report on Seeking Alpha that somebody published, and the stock literally cratered like 50 or 60%. It was crazy.
Oh,
And so it was one of those things where it was kind of on my watch list too. And I was like, it kind of looks interesting, kind of red flag management team. And I kind of wrote it off. But it's so interesting that you bring this up because one other company that I've invested in the past and done really well in, and we've talked about it before, is Liberated Syndication, which is primarily a podcast hosting company. So they bought a website hosting company, so they've diversified a little bit. But the situation there was the management team. So I mean, when I bought it, it was like a 5 million market cap company. It was tiny, but it was trading at 3 times earnings, and it looked to be this incredible, profitable, growing business if it wasn't a fraud. And that was the big if, because the issue was that management had essentially, so the same management team was running this company that had previously made an acquisition in China that ended up being turned out to be a fraud. Literally, the chairman of that company, the chairman of Liberated Syndication, he's probably not the chairman anymore, but I think he's in jail right now. The guy who sold him the business in China, last I heard, and still owns like 10% of the stock, I think. But basically, first of all, they acquired a business that turned out to be basically a complete fraud. And then they basically told shareholders, no, it's all good. Everything's great over there. Meanwhile, they were selling all their shares and they got sued and were found settled, without admitting any guilt, of course, with the SEC, that they basically, did insider selling. And so that was kind of the backdrop that I looked into this company with. And that was the reason why nobody wanted to touch it with a 10-foot pole. But it actually created the opportunity because nobody wanted to look at it. It was, from my perspective, there may be an incompetent management team. They acquired a company that turned out to be a fraud. They're sleazy characters. They sold their stock while telling investors that everything is all well and good. But they themselves didn't commit outright fraud. They weren't cooking the numbers. And meanwhile, like objectively, you can look at Liberated Syndication and the GAAP SEC reported numbers look really good. And meanwhile, you could just Google like what are the best podcast hosting networks, and the far and away favorite, and that's changed a little bit now, but it was Liberated Syndication. So you could independently verify that this was actually a real business. And then in terms of incentives, Greenblatt says follow the incentives. That's my favorite thing. That's what I try to do. What was interesting, and you kind of have to. It's like kind of like a I don't know, Prisoner's Dilemma or Game Theory or some sort of game where basically management had insider sold all their stock before it had tanked, so they owned nothing. But the company was radio silent. But the reason that they said that they wanted to spin off the company was to remove the taint of Fab Universal, which was the previous name of the company, and because they thought the stock was undervalued. So that's what they legit or like straight up said it was an S1 filing, not a Form 10. And my thought process was, okay, they don't own any of the stock, but this is a stock that's trading at 3 times earnings, 2 times earnings, growing 20% a year, 40% EBITDA margins. They're going to give themselves a lot of stock, and it's going to turn out to be really, really valuable. And sure enough, they were radio silent for basically 9 months. And then sure enough, huge issuances of shares. And then they started to come out and tell the story a little bit more. And they literally granted themselves like 30% of the stock. So without spending $1, they diluted shareholders by 30%. But the stock's up, 15 times from that, despite the dilution. So it's really interesting. It's like, yeah, it's a management team that you can't trust. Yeah, they're gonna try to dilute them. They're gonna issue themselves shares, but that actually works out to your advantage because that's going to encourage them to actually get the stock price up. And even with 30% dilution, the stock is, incredibly undervalued. One other thing I just wanted to mention, in terms of incentives, you want to follow the incentives, but it is hard sometimes with the larger cap spinoffs, because all of them, I would say, I always search for what percentage of shares are reserved for executive compensation, and it's always a real large number. So like management team always has the incentive to get the stock price up, and they're all going to get a bunch of shares. But if they already own a bunch of shares, they're going to get, and they're going to get a bunch more shares due to the spinoff. And then again, if you see like something like insider buying, or you can kind of get a theory that, this company's flying a little bit underneath the radar because they want to issue themselves shares before the stock price skyrockets. It's kind of like being, like Buffett says, like an investigative reporter. You have to like dig deep and try to get inside their heads and try to figure out what they're thinking.
Yeah, absolutely. I really appreciate you sharing that story about liberated syndication. That's actually part of the reason why I like investing in spinoffs so much, is because you get some really interesting stories that kind of happen. It just
Totally.
And yes, they happen in other areas, but it seems like they happen a little bit more frequently here, and it's just really, it's kind of fun. It's just interesting to do. So.
Yeah, no, exactly. It's fascinating.
Well, awesome, Rich. Do you have anything else you want to share before we close up?
No, I think that covers it.
Awesome. Well, thank you so much for being here, and I'm going to try this one more time. We'll share the last part of the disclaimer. Maybe we can actually get it to work, and we have some music with our show today. So here we go. As we finish up, we have one final note for you. This video was made for educational purposes only. Any companies mentioned in this presentation were discussed for educational purposes only. Discussing such companies and the specifics about them is for illustrative purposes only and not a solicitation to purchase them. We recommend that you conduct your own research and identify why you might want to own the company yourself before you commit any funds. We also recommend that you seek the services of a financial advisor that has considered your situation as your fiduciary. May your education here grow your knowledge, improve your personal investing performance, and give you the confidence to take control of your future. Thanks.